Well, a stronger national economy has the Federal Reserve Bank scaling back the amount of money it's injecting into the economy each month, fueling speculation. We could see everything from higher interest rates to lower land values. I sat down with Nathan Kaufman, the head of the Omaha branch of the Federal Reserve, to talk about that and other trends affecting our rural economy. Well, Nathan, Oklahoma City continues to lead employment growth here in the state. In some of our non-metro areas, we're starting to see a little bit of a fall off in employment. What do you think that might be?
I think there's a couple things specifically in Oklahoma. In the rural areas, you think about commodity prices. And in particular, you look at oil prices as an example, natural gas prices. You also look at crop prices. When you look at those prices and you get into the details, you start to see that prices have been falling. And they are expected to potentially fall going into the next year or two. That's really been driving some of the profitability in those sectors and really what boils down to some of the employment gains in rural areas and income growth in those areas.
So we're very proud of the diversification we've been able to do really since the 80s when we had a real downtime here in Oklahoma. Yet are we foolish to forget the importance that two commodities play, ag and oil, in the state's economy?
I think that it's something obviously to think about, and any economy would want to be diversified to the extent that it can be. The dangers that are out there right now are particularly thinking about the agricultural side. Crop sector, farm incomes have been very, very high the last few years. Now obviously the livestock sector has been a different story. There's been some challenges there with drought and so forth. But the challenge going forward is that incomes in the ag sector and in a lot of those rural areas are expected to be a little bit lower. And at the same time, you've got a lot of unconventional energy reserves that are being tapped that are driving crude oil and natural gas prices down and limiting further production there. And so you've got a couple of key commodities for the Oklahoma economy that have slowed down a little bit. And in terms of thinking about gains in the next year or two, present some concerns for some of those rural areas.
So as we transition to lower prices, whether it be agriculture or energy, could we risk another bust?
That's been a question that's been out there, to be honest, for some time, especially looking at where farmland prices have been. That's been one area where people look and see that there's the potential that those prices that are out there right now might not be sustainable. I would say that when we compare that question, thinking about the possibility of a bust with, let's say, something that happened in the 1980s in the farm sector, one of the key things is thinking about debt and leverage. In the 1970s and into the 1980s, leverage was fairly high. Today, leverage is pretty low overall, and so when we think about the possibility of a bust, that's a key component there. So there is a recognition that there's risk in leverage. Underwriting standards are obviously very different right now than they were in the late 1970s, early 1980s, so that's another point of difference. Now, having said that leverage is relatively low right now, there are some operations that are a little bit more highly leveraged. You think about some of the livestock operations that have been experiencing some hard times here recently, or you think about young and beginning farmers that are wanting to get started and have limited collateral to begin with, or limited equity to begin with. So those operations tend to be a little bit more highly leveraged, but overall, I think that people are being careful. There's a lot of people that remember the 1980s, that remember how awful that time was, and they're being careful in terms of adding new debt.
Now, we've had fairly record low interest rates. You're with the Federal Reserve Bank. Sometimes they're criticized, sometimes everyone welcomes them a lot. Do we risk, with that monetary policy, people not being as careful as maybe they should?
That's been something that's been talked about, is the possibility that a prolonged low interest rate environment might start to drive investors to more risky assets seeking return. So with the Fed funds rate being at zero for a relatively long period of time here, there's thoughts that may start to drive investors to other areas, risky assets, potentially looking at farmland as an investment. And then thinking about where farmland prices have gone the last few years, there's questions about how much monetary policy and low interest rates are contributing to that, with the key being that eventually interest rates are expected to rise, that would present a risk for those segments of the economy where there may have been more investments in the last few years.
In terms of our rural economy, what wild cards do you see out on the horizon?
I think one of the big things is what's happening in fiscal policy, to be honest. And there, we hear a lot about uncertainty in today's economy. And you can write out a number of different possible cases for uncertainty, whether it's something that's coming from what's going on in the Middle East, or whether it's the government shutdown or the deficit, and some of those things that are out there. In rural areas, it might be the Farm Bill. There's just a lot of uncertainty out there, and it has really hindered, from what we see and what we hear, it's hindered decisions to plan for the long term. Businesses are reluctant to hire, they're reluctant to invest, and so that's in some ways hindered then job growth and in rural areas in particular.
So Nathan, I guess the elephant in the room is what makes now different than the bust we did see in the 1980s?
I think one of the main things that I would try to emphasize is when we think about the potential for a bust in the next couple of years, if you think about lower income or even potentially beyond 2015, and thinking about comparing that with the 1980s, the key there again is leverage. And so when you think about how to protect against something like that, it would be maintaining working capital, maintaining levels that you could be able to absorb a shock that might come in the short term, where that leverage in the 1970s and 1980s was a little bit higher than what it is today. Thinking about maintaining working capital is one protection against that.
Thank you for your insights.
You're welcome.